Welcome to Biz Help for You with host Candy Messer. Entrepreneurs like to focus on the big picture, like profitability, success, and a smooth-running organization. But there always seems to be those little things like taxes, employee compensation, laws, regulations, and more. Now you can get the answers you need in one place. Join us today as we break it all down for you. Now, here's your host, Candy Messer.
Hello and welcome to Biz Help for You with Candy Messer. Thank you for joining me today. I hope you enjoyed the topic of my last interview. And if you missed the episode and would like to listen to the show, links can be found on my YouTube and Facebook pages, as well as multiple favorite podcast platforms. If you'd like to receive notifications on when my podcasts have been uploaded, please like and subscribe. Today, I want to go over some topics that affect business owners when it comes to taxes. There are often questions about if something is tax deductible, how to claim the deductions, and more. Although I'm not a CPA and I don't file personal or business income tax returns, I do help entrepreneurs to apply the tax law to their bookkeeping and help them understand the impact on their businesses. So let's jump into the information that I've prepared for you. As an entrepreneur, there are 4 important categories to understand for your taxes that you have to deal with. And those are income tax, self-employment tax, payroll tax, and sales tax. Now, although I will be focusing mostly on tax deductions for income tax today, I'm going to cover just briefly these 4 areas just so you're aware of what you need to be looking out for. So obviously income taxes are the main one that people always think about. And just like any other member of the workforce, all self-employed individuals are subject to income taxes. So your federal and state income tax bracket will depend on how much your business makes, along with other personal items that may affect your taxable income, such as capital gains or the child tax credit. Your business income is comprised of all your revenue less your deductible business expenses. So self-employment taxes. In a traditional employment situation, the employer pays a share of Social Security and Medicare taxes that were paid on wages to the employees. However, if you are self-employed, you are essentially responsible for both the employer and employee portion of these taxes. Unfortunately, this means that you are charged double the taxes of an employee in a company. The self-employment tax rate is 15.3% of all income up to the max wage, which increases annually. For 2023, the wage cap is $160,200. 2.9% of all the income that you earn is taxed. This is the Medicare tax. And again, the Social Security tax will be that max cap rate. And again, that will go up every single year. So you can lessen the sting of these taxes by deducting half of the amount of your self-employment tax on your annual tax return. Other payroll taxes may need to be paid. So if your business has employees, you are responsible, again, for half the Social Security and Medicare taxes that I just discussed for each individual that you employ, as well as unemployment and state payroll taxes. You must also withhold income taxes from their paychecks and make the required deposits to the IRS in order to avoid a trust fund penalty. And of course, if there are state taxes as well, then you will pay to the state agency. These taxes are due on a specific schedule based on the amount of federal tax withheld in the look-back period. And the look-back period is usually from July 1st of one year to June 30th of the next. Very few people can pay annually. Most must pay monthly or with each payroll run. So if you owe $50,000 total federal tax amounts to the government in that look back period, you will be what's called a semi-weekly depositor. And every time you run a paycheck, you will have to pay within a few days. The dates for payments that are due are either Wednesdays or Fridays. If you're a monthly tax depositor, then it's due on the 15th of the month following the month that the payroll taxes were accrued. So January is due February 15th, etc. Now, of course, if the 15th falls on a legal holiday or a weekend, then it is advanced one business day or until the next actual business day. So for instance, if a holiday falls on a Friday and the tax is due on that day, the 15th, obviously Saturday would be 16th, Sunday would be the 17th, so your tax would actually be due on the 18th. Sales tax. You are responsible for collecting sales tax on products that you sell. If you are a brick and mortar store, you're simply observing the tax laws in your area because customers are coming to your location, so you charge the rate of your location. However, if you also sell online, you may need to collect sales tax from the region in which your buyer is purchasing. Rules regarding this taxation vary from state to state. So it's important to understand that the tax amount to collect is based on where the goods are received. So if you're shipping to a customer, be sure to collect the rate for the location that the merchandise will be delivered to. It's also imperative to keep up on the sales tax rate changes. Cities and counties increase their rates periodically when voters approve the change. So keep up with any location in which you sell your products and services. Many also think that they're not responsible for collecting sales tax because they offer a service. But unless a state specifically exempts services, they are also taxable. And what may be non-taxable in one state may be taxable in another. So do your research to make sure that you are in compliance. As an entrepreneur, taxes can seem frustrating and overwhelming. After all, you're accountable for paying proper taxes not only for yourself, but on behalf of your employees and your business. That's a lot of responsibility. However, by understanding the rules of income tax, self-employment tax, payroll taxes, and sales tax, you can ensure that you are paying the proper amount and avoid the headache of an audit or a trust fund penalty from the IRS. The trust fund penalty is a higher penalty because you have withheld amounts from your employees that you're supposed to forward on a schedule. And so that is a higher penalty because it's considered your employees' money, not your own. So knowing your duties as a self-employed taxpayer also brings you peace of mind and keeps your energy where it should be on running your business. So another important topic to discuss is that of how to determine if expenses you incur as a self-employed business owner are deductible for an activity that you consider a business, but the IRS might say it's a hobby. So what are the hobby versus business factors? Whether it's the startup of your dreams, it's a side gig to which you devote all of your spare time, or your main moneymaker, if you've taken a big loss in your endeavor, while deducting your expenses as that of a business, there comes a time when the IRS will question whether you're running a business or you simply have a hobby. I recently had to let a client know that due to her claiming losses for 3 years in a row, the IRS will determine that her business is a hobby instead of one meant for profit. But there are actually 9 factors that the IRS uses, not just if you're profitable or not. Let's take a look at these. The first one is the manner in which the taxpayer carries on the activity. So the first thing a tax court will look for is proof that you are conducting your endeavor like a business, which can often mean anything from keeping accurate bookkeeping and records to maintaining business-like policies and separating business and personal accounts. Do you have a business license? Are you advertising to bring in new customers? Are you working to gain knowledge through attending webinars or conferences? It's important that it looks like your intention is to carry on a business for this factor to go in your favor. Number 2, the expertise of the taxpayer or his advisors. Over time, you should be improving your skill in your industry. The IRS also looks to see if you have spent any effort to continuously learn about your trade, especially when relating to market research and how to make your endeavor more profitable. Are you reading trade journals, attending industry-specific trainings? Be sure that you're doing what you can to improve what you have to offer your clients. It's also important to have advisors you can turn to for assistance and support to help you understand what you can do to improve the likelihood of success. If you don't have resources at your disposal, you risk the IRS deeming your activity a hobby. Number 3, the time and effort expended by the taxpayer in carrying on the activity. So in the case of a hobby, it's usually only pursued when convenient or fun to do, which is exactly why the amount of time and effort spent working throughout the week is a great tell whether the endeavor is a business or not. All of us who've been in business know there are times it's not enjoyable to run a business, whether it's due to working more hours than we like, dealing with customer issues, managing human resources if employing a staff, or other stressful situations. We must work even when it's not enjoyable to keep the company running. Number 4, the expectation that the assets used in the activity may appreciate in value. So put simply, is it possible for you to make a continuous profit given time through the activity or not? If there's little likelihood that you can make what you have into something greater, bringing in greater revenue and profit, the IRS will most likely consider it a hobby. Number 5, the success of the taxpayer in carrying on similar or dissimilar activities. Tax courts may also look at your success with business endeavors in the past, namely whether or not you were able to make a profit or if you failed eventually. Many entrepreneurs begin with one business and change their focus down the line. But if you operated a successful company in the past, it is assumed you will have a good chance of doing so again. Number 6, the taxpayer's history of income or losses with respect to the activity. Past endeavors are fine, but what about the one in question now? Have you managed to make a profit within the time that's to be expected? Is that profit predicted to increase slowly with more time? If you're starting up a new endeavor, it's expected you may have losses, but does it appear you will be able to become profitable within a reasonable amount of time? That's the question the IRS will be asking. Number 7, the amount of occasional profits. Bottom line, if as a business you're defining yourself with an endeavor to have the intention of earning a profit, then that's what they're going to be looking for. So if the number of profitable years are slim or inconsistent, then it's likely a hobby. The IRS wants to see profit in 3 of the last 5 years. They don't have to be consecutive years of profit, but you must still be profitable more years than not. Number 8, the financial status of the taxpayer. If you are offsetting losses through another income source, as the endeavor is neither earning a strong profit or taking up a majority of the taxpayer's time, you're busy doing other things, then this can be a red flag. If you spend limited time working to make your activity profitable, especially because you have another job or you invest personal funds into the business to keep it operating, the IRS will most likely consider you are doing it for fun and not for financial support. And finally, does the activity lack elements of personal pleasure or recreation? While no one ever said you can't love your job, it's still work. So if the endeavor is seen as too fun, a tax court may wonder if it's more of a recreational hobby. Either way you look at it, a business is meant to earn you income, so it makes sense that the IRS would suspect if you're spending time and money on something that's not earning you a return. So in summary, you won't know until after you've operated your business and filed your expense deductions whether the IRS is going to question if your activity is truly a business or a hobby. But as miscellaneous expense deductions, commonly used for hobby taxes, are no longer allowed, make sure you don't miss out on important tax deductions by keeping in-depth records of your business endeavors while proving the success that you strive for. If the IRS ever questions the deductibility of your expenses, the more support you have to show you operated it as a business, the better. Now, let's go on to meals and entertainment. So one of the tax deductions that was straightforward in the past now can cause some issues. Are you a business owner that takes customers or potential clients out for dinner or other types of entertainment? It's been a few years since the updated meal and entertainment rules went into effect in 2018, but I still see some people handling these incorrectly. Whereas in the past, you used to be able to write off 50% of your entertainment or meal costs and 100% of your charitable donations, the new tax law has required that no entertainment be written off and only meals for travel are 50% deduction. And of course, taking out potential clients can also be considered a meal deduction. And now charitable organizations would need to break down the total cost of a ticket price to show how much covers the actual event expense and how much is over and above, and only the amount over and above the actual expenses are able to be written off. For instance, if you purchase a ticket for $100 and the cost of the meal is $40, you can only write off $60 as a charitable contribution. If you donate $50 to an organization and they send you a $5 gift to thank you, the deductible amount is $45. So if you're counting on these tax deductions to help you save this coming year, be aware that it's not possible anymore. The only thing that you can do is have the special meal, have a celebratory event. You can still, of course, get a portion of the write-off for a meal with a potential client or thanking a current client, of course. But some of the things that you used to be able to write off, especially entertainment, are not able to be written off. People used to enjoy taking their friends or business colleagues to event like a sporting event or a concert or things like that, and that entertainment really is no longer allowed as a business expense. So it's really important for you to track the amount of your expenses in the proper categories so that you can give to your CPA what is going to be taxable and what is not taxable. Also, when talking about charitable contributions, it's really important for you to make sure that the nonprofit organization gives you a breakdown for the ticket price so that you can write off the portion over and above the expenses that they incur for that deduction to be able to be written off. It's also imperative that your bookkeeping tracks all of this properly. If you lump everything into a meals and entertainment account, the CPA is not going to know which ones really still qualify for the 50% write-off and what is no longer deductible. Set up one meals category to track deductible items used for client or other business meetings, and entertainment as its own expense account. And also remember, to be able to prove that deduction for the meals, be sure to write the name of the prospect or client that you're taking out and the purpose of the meal, and put that right on the receipt and save a copy of that so that, again, if you're audited, you can prove that that meal truly was a business meal. So again, the IRS has said that if you attend an event and you can split the cost of entertainment and food through itemizing the costs, the food portion will be still 50% deductible, although the entertainment will not be deductible. So ask for a bill breaking out the different costs to allow you to write off some of the expense that you incur. Be sure to accurately track all meals, entertainment, and charitable contributions properly to get the maximum deduction possible. Now, let's talk about due diligence being critical when it comes to charitable donations. While on the subject of charitable contributions, I want to share tips to help you verify that you are donating to IRS-approved organizations. As Americans, we tend to make most of our donations to charitable organizations at the end of the year. However, the fact is that it does not matter when you make a donation to charity. It's important to do your due diligence on the organization before making any donations to it. Do you give to charitable organizations to assist them with their financial goals? Be sure when you make a donation that the organization is providing proper documentation and you check them properly to make sure you're donating to the one you think you are giving to. In order to make the process a bit easier and make sure that you're getting credit for your charitable donations, here are a few steps to follow. Check the organization's status. 501c3 is the most common type that accepts donations and allows people to write off the deduction. Depending on the type of organization, there are others that allow this type of donation and deduction combo. Receipt, receipt, receipt. While all donors should automatically get a receipt for their donations, nonprofits are only required to provide them for donations greater than $250. So make sure to ask for a receipt every time you donate. But of course, if you don't get a receipt, save the check copy or your credit card statement to prove that you did make that donation to the organization. If you're planning to give to a new organization for the first time, make sure it's legitimate before doing so. Prior to your donation, take a few minutes to research the organization and make sure that they are actually doing the work that they claim. There are plenty of legitimate and illegitimate organizations out there trying to get donors to give to them. Some organizations also make their name sound almost exactly like a valid one, so be sure you verified the spelling and all the words match who you think you are giving to. Ask these questions. Are they being financially transparent? Do they explain how their donations are being used? Is a decent amount of their donations going towards the programming? You can check out guidestar.org, give.org, or charity.org to find out their detailed financial information in order to see if they are the type of organization you want to be donating to, or somewhere with less overhead and more money going into helping their actual programs. If you're hoping to get a tax deduction on your donation, the funds must be in the hands of the organization by December 31st in order to claim it on this year's taxes. And while giving money as a donation is a great way to support them, remember that there are other ways to donate as well, such as donating stocks and bonds, making a charitable bequest to the organization. And before doing that, make sure that you speak to your favorite organizations to make sure that they're able to accept and handle alternative donations. And of course, if you want to help out an organization, you can also donate your time, although you cannot get a tax deduction for time that you donate. It is important to vet a charitable organization before giving. It will make handling it at the end of the year much easier. If you're unsure how donations will impact your tax return, be sure to chat with your CPA. Another item that can be deducted incorrectly is in relation to business gifts. Are you over-deducting gifts? Most of us give family and friends gifts for Christmas, birthdays, or just to say thank you. Although personal gifts are not deductible, one can deduct at least a part of the cost of business gifts to customers, whether the gift was direct, given directly to the customer, or indirect, giving it to the customer's family or to the business for eventual personal use. Here's the catch. There's a limit of $25 per gift. Here's how it works. Let's say you give 3 different customers each a gift that costs $50 a piece, a total of $150 for all 3. You can only deduct $25 per gift, or a total of $75. If your gift costs less than $25, then you deduct the whole cost. When you are calculating the cost of a gift, incidental costs are not usually included. Examples of incidental costs include gift wrapping, postage, and other costs that do not add substantial value to the gift. On the other hand, let's say you're giving pineapples and oranges a fruit basket, and you want to purchase an ornamental basket to present the fruit in. In this case, the basket would be part of the cost since it adds value to the gift. This does not apply to quantities of similar items of small value under $4 that have your company name on them and you frequently distribute. An example might be company pens, tote bags, calendars, or notepads that you give to customers or prospects. Signs, display racks, or other promotional material to be used in the business premises are also not considered gifts. So I know you're probably thinking, you can't buy much of a gift for $25, and you're right. Unfortunately, even though costs continue to rise, the IRS has not changed the value allowed for the deduction. So be sure that you monitor how much you can legally deduct when giving your tax information to your CPA for annual filings. Now, let's discuss a deduction that you may have, especially now that many have been able to avoid having a commercial office space. And that's calculating your home office expense deduction. So are you an entrepreneur using your home office for business purposes? Are you aware that this deduction allowing you to expense the use of your space and that there are 2 different ways to calculate it? The home office deduction is one of the most sought after. and sometimes confusing tax deductions for small business owners. While it is often misunderstood and misused, the rules surrounding this tax benefit are actually fairly simple. If you work from home as an entrepreneur, deducting a portion of your expenses is incredibly alluring. Taking a home office deduction can lower your tax liability and reduce what you owe at the end of the year if done properly. The IRS has very specific guidelines as what constitutes the use of home for business. So let's take a look at the factors to see if you qualify for this deduction. There are several important guidelines that your home office must meet in order to qualify. The first factor is regular and exclusive use. This means you can't have your laptop on the kitchen table, but you must have a specific place used only for business purposes. Secondly, your home must be the principal place of business, although there are exceptions if you have a separate location. Since 2013, the IRS has had two different ways to calculate the home office deduction. Originally, there was just the actual expense method, which is considered the most complicated. Since the simplified method has been introduced, it is much easier to determine the amount of the deduction, but which method should you use? A simple way to calculate your deduction is to multiply the square footage of the business space within your home and multiply by $5 per foot. If you're using this method, you are limited to 300 square feet of office space for a $1,500 deduction, and you cannot claim other in-home expenses such as utilities. The actual expense method allows you to write off the proportional amount of expenses based on the percentage of the home used for business. These indirect expenses generally include mortgage, real estate taxes, utilities, and repairs and insurance. You can also deduct direct expenses such as painting or buying equipment for your space. If your office is larger than 300 square feet or your utilities make up a significant portion of your business expenses, you may want to calculate using the regular method. For example, if your home is 2,000 square feet and your office is 250 square feet, then 12.5% of your house is used as an office space. You can then determine the exact amount that you're able to deduct based on your housing costs. The benefits of using this method are that you are not subject to a square footage cap and can also deduct applicable expenses. With the actual expense method, you must keep copies of all paperwork proving the actual cost to support the tax deductions taken, which is not required for the simplified method. However, by using the actual expense method, you may be able to deduct more than with the simplified option. Knowing the guidelines for taking a home office deduction is imperative to make sure that you are filing your taxes correctly and will not be penalized if audited by the IRS. However, if done properly, deducting your workspace costs can be a game changer for your business and can lower your tax liability. If you aren't sure which method to use, contact your CPA and discuss your specific situation. There are a variety of tax deductions available to you as a business owner. The important thing is to understand the rules around which expenses are allowable. If you're unsure how this rule applies to you, then be sure to speak to your CPA and set up your bookkeeping accurately to track payments that you make for all the categories. So thank you for tuning in today. I hope you found this topic interesting and you enjoyed the topic that I had with the tax deductions for small business owners. And if you have any additional questions or comments, be sure to reach out to me at media@ab&p, or again, talk to your CPA to make sure that you can claim all the deductions that you qualify for. And I hope you can join me for my next interview. And remember, you can connect with me on Twitter, Facebook, and LinkedIn. And my website is abandp.com. You can also find the podcast Biz Help for You on many podcast platforms, including iTunes, Google, TuneIn, Stitcher, iHeartRadio, and Spotify. And would you please leave a review of my show on your favorite platform? I would really appreciate your support. Until next time, have a great day.
thank you for listening to Biz Help for You. Please join your host, Candy Messer, again next time. Have a terrific day.